Hey guys, happy Saturday. I hope you're all having a great Memorial Day holiday weekend. There were a couple of updates on Wolfspeed, ticker WOLF, a upcoming bankruptcy play that we talked about on a morning live stream on Wednesday the 21st after the stock plummeted. And it's been a great swing trade for those of you that bought at 80 cents and were able to get out above $1.60. Easy doubling your money in a day or so. But I do want to urge some caution and go over some of the news that dropped from Wolfspeed over the last couple of days. And just so we're clear as we get started in this video, I do not have any position, positive, negative, long or short, in Wolfspeed. I generally don't play bankruptcy plays. Sometimes I do. I played Hertz because that one was different. But the other ones like Bed Bath & Beyond, I just see people bashing their head into the wall, doubling down, trying to buy the dips all the way to zero. And that is my concern, that people are going to do the same thing here with Wolfspeed. My opinion, how it's going to turn out, will be a debt restructuring, which will significantly negatively impact common stockholders. And in this video, we're going to go over the communication from the company in the last couple days that kind of bolsters my opinion. I just put this out here for education and sharing. If you have a different opinion, that's fine, and you can let me know about it down in the comments, as long as you can communicate like an adult. Let's get right into the info. This type of pattern that we see on the chart here is very common in bankruptcy plays. When the company announces news or the media announces rumors that the company is going to have a Chapter 11 filing, you get this severe correction like happened to Wolf on the 21st, where it dropped from the $3 to $4 range down to 82 cents in just a couple of hours. And then after that very strong correction, if you're bold enough to buy in, very often they have a quick bounce back up. And that would be typically from shorts who made a lot of profits with that massive crash in the price, closing out some of their shorts, locking in their gains, pushes the price up. But the problem that retail traders make is they see that as strength. Oh, you know, we should buy that dip. Everyone's buying that dip. It's mostly just shorts covering and locking in their profits. And then you get the price starting to push back down. And that price will continue to push down until you get the ultimate news that the company filed Chapter 11, or if there was positive developments and they said definitively we're not going to do a debt restructuring, then you get the move up. But in this video, I want to go over a couple of key things with you that the company said, why I do not think the positive outcome is a very realistic one. Let's look at their last 10Q and then the news from this week. As evidence of the predictability and repetitiveness of this sort of bankruptcy play chart pattern, I want you to look at this chart where we had a company, SPWRQ, that had rumors of an impending Chapter 11. It dropped from 250 down to 70 cents, had a little bit of rally, which was shorts covering, locking in their profits. And then a couple days later, the eventual news dropped that the company was filing Chapter 11. All of a sudden, the people who thought they were buying the dip here got completely wiped out as the stock plummeted from 80 cents down to less than 1 penny. And if you are daring to speculate in Wolfspeed right now, this is what I do not want to see happen to you. Similar pattern with BBBY, although the rumors were swirling for a long time that the company was going to have to file Chapter 11. The price got knocked all the way down from 30 bucks down to 27 cents. The company filed Chapter 11 on April 23rd. The stock got knocked down from 26 cents to 10 cents, as low as 4 or 5 cents if you count this tail here on the bottom of this green candle. And then people that bought that dip thought that they were doing really, really good. For a few days, the stock traded up to 30 cents. And then the inevitable happened. The ticker got delisted and everybody got wiped to zero. Again, very predictable patterns of what happens in bankruptcies with these severe dips, a little bit of correction, and then the final hammer blow. If you're daring to speculate in these stocks for that dip and the bounce, you definitely want to be out before that final hammer blow absolutely kills the play and your portfolio. What I'm going to show you here is not my opinion. This is the company disclosure to you, the investors, in their most recent 10Q. And you can find this information in the liquidity section, which is at the bottom of page 11 and the top of page 12. This is critical reading for you if you are trying to invest or buy the dip on Wolf. I want you to carefully listen to the highlighted sections because this is not me trying to scare you. This is not me trying to share an opinion with you. I am reading to you the company disclosure to investors. It says, considering the significant amount of the company's outstanding indebtedness and related debt service expense, the company engaged external advisors to assist with the evaluation of a number of strategic alternatives, including a potential out-of-court or in-court capital restructuring. It goes on to say, and this is in direct opposition to what a lot of people on social media are telling you, it goes on to say there can be no assurance that the company will reach an agreement on acceptable terms and conditions with respect to a restructuring or a transaction in a timely manner or at all. I see a lot of people telling you, oh, for sure, they're never going to go bankrupt. I mean, the company's telling you right here, there is no assurance from them that they will be able to come up with acceptable terms. And if they can't, that is going to result in a in-court restructuring filing. Any restructuring, they go on to say, or other transaction to which the company may agree may be conditioned on a requirement that the transaction be implemented through a in-court solution, i.e. Chapter 11. There can be no assurance that the company will pursue or successfully complete a restructuring or other transaction. Any restructuring or transaction is expected to be costly, would be substantially dilutive to the company's existing shareholders. I repeat, will be substantially dilutive to the company's existing shareholders. You guys who are buying the dip are going to be substantially diluted from the current price down to probably pennies, if not zero. If the company has $1.3 billion in cash, though, why is this happening? And that is a good question. They answer it for you in this same section. It says, highlighted at the bottom of this page, that scheduled debt repayments and debt service costs of $575 million and $322 million, respectively, over the next 12 months are coming due. That alone right there is over $900 million. Keep that number in your head for a second. They close this section by saying management has concluded that there is substantial doubt about the company's ability to continue as a going concern. And if you've watched my channel, you know any ticker we talk about, when we see that, I highlight to you guys that that is an extremely high risk disclosure of an upcoming Chapter 11, and 90% of the time they do result in a Chapter 11 debt restructuring or the company shutting down. I do not think that Wolf is going to shut down. A debt restructuring would enable the company to survive, although it will most likely end up in the company being taken private, given to the bondholders, and common shareholders being written down to zero, no recovery. But Tony, $1.3 billion, you said that they only have $900 million spoken for. That still leaves them, what, $400 million? Let's see what the company tells us in the 10Q regarding the 2030 senior notes. There is, in the second paragraph here, a disclosure to you guys, the investors, that those notes include a liquidity maintenance financial covenant, a very common thing where bondholders put in a requirement for companies to maintain a certain level of cash in case things get dicey, in case they might have to file a bankruptcy. The lender wants a lien on a certain amount of liquidity that doesn't get siphoned away, doesn't get spent on dividends, doesn't get spent on share buybacks, all the things you see people on social media wishing for right now. Those are not going to happen because the company's got the debt payments, the interest payments, and this $750 million financial covenant, a minimum liquidity requirement. And if you add up 900 million on the debt and interest coming due and 750 million that is locked, restricted, financial covenant lien, that is $1.6 billion more cash than the company has available. And since the company is losing money at the moment, they are functionally out of cash for the next 12 months. That is why they are considering and most likely will enter into a prepackaged Chapter 11 or be forced to enter into a regular in-court regular Chapter 11. There was a little bit of other additional news from the company that got the bulls excited. This 8K on May 23rd saying that the company hired a new chief operating officer, Dr. David Emerson, a industry veteran. And this is a perfectly reasonable press release. Like I said, I do not think that Wolf is going to shut down, even if they do a Chapter 11 or a restructuring. That is to get the debt burden off of the company so the company can continue. Everybody's going to keep their jobs, most likely, including Dr. Emerson. However, through that process, the common stockholders will likely be wiped out or substantially diluted as equity is given to the bondholders in exchange for reducing their debt. But at the very bottom of this 8K was a little section tucked away that, unless you read it very closely, you might have missed this. It says here at the bottom of the 8K, the company continues to engage in ongoing constructive discussions with its financial stakeholders, that is the bondholders, around a comprehensive solution to support the company's long-term growth plan in connection with its discussions with certain lenders. As the company works to shape its next steps, it intends to elect into a 30-day grace period for its interest payment due on June 2nd, 2025. Things are so dire in terms of their cash position that they have gotten a 30-day grace period from the lenders to not pay that debt interest payment that is coming up. And that is, my friends, how serious the situation is here at Wolf, where the lenders are saying, look, don't even spend cash on interest payments. Let's figure out the details of this debt restructuring because we might want that cash as part of the restructuring, not as an interest payment. This, in my opinion, is not a bullish sentence. This is underscoring the seriousness of the cash problem that Wolfspeed has and the very increasing likelihood that a Chapter 11 is imminent. A lot of people at the end of last week were expecting the company to issue some formal news rebutting or denying the rumors that they are filing Chapter 11 or seeking a prepackaged Chapter 11 or going to consider a debt restructuring, and they were trying to put timelines on it. The company has 24 hours to respond or else. They've already disclosed to the public, to the SEC, and to investors in the most recent 10Q that they are considering a debt restructuring, which could be in court or out of court debt restructuring, which would include a Chapter 11. Don't expect that they have anything else to say other than what was filed as a disclosure to you from the company in a quarterly 10Q. That is all of the information that they have to communicate, and it only corroborates the rumors that are swirling around there on the media. They're not going to issue a denial. We do have this email, though, from the company CEO that got leaked. The email is to employees, and he says, I want to emphasize that no decisions have been made regarding our path forward, and we are committed to providing you with an update once there is definitive news to share. Key points to remember: work is underway to strengthen our capital structure via a long-term comprehensive solution for the business. One of the potential alternatives we are evaluating is a transaction through a in-court solution known as Chapter 11. This in-court transaction would be a voluntary process, that's what Chapter 11 is, that allows companies to operate normally. Like I said, they're not going to shut down. They will operate normally while they work through a structured legal process to significantly reduce their debt level. Why do I say they're not going to shut down? Because I think that they still have a viable business. It's not going to be a Chapter 11, I don't think, like BBBY, where they sold off all the assets, fired all the employees. I'm not expecting that with Wolf. I think they want to restructure the debt, get a workable financial statement, and then continue on improving the business, hence the hiring of the COO. But that debt restructuring will be substantially dilutive or decimate common stockholders. The CEO goes on to say to his employees in the second bullet item, while no final decisions have been made in this option and all of the options we're evaluating, we intend to continue to operate the business normally as we work to reassert our position as a global leader in the silicon carbide market. Yeah, reaffirming what I just said. They're not going to shut down. At least that is not the intention at this moment. He goes on to say, importantly, we finished the quarter with $1.3 billion in cash, and we believe we have sufficient near-term liquidity to support the business. Near term, yes. Over the next 12 months, no. As I just went over with you the disclosure from the company about the debt obligations coming due, the interest payment obligations coming due, and the lien on $750 million in cash on their balance sheet. Near term, they got enough cash to keep the lights on and get your paychecks out there if you're an employee. But over the next 12 months, it is not going to be sufficient. And that is why they put the going concern warning in the 10Q, a disclosure to investors. That is all I got for you guys on this video. Hopefully you're paying very close attention to communications from the company in the 10Q over everything else. Forget what I said. Forget what all of the pumpers, promoters are telling you on social media. Spend some time reading those risk disclosures, the bond covenants, and the liquidity sections in the 10Q, and get your communication directly from the company, because that, my friends, is your most likely outcome. And it does not look good to me just standing back, logically looking at the financials from an unemotional, uninvested viewpoint on this. I watch these plays for education for myself and for you guys, and I would put my money on this thing ending up in a prepackaged or in court Chapter 11. We will find out in the next couple weeks. If you're trading the stock, be smart and good luck to you. I'm Tony Denaro. Thank you for watching, and I will see you on the next video.